1.
Okay, great. And do you see the PowerPoint on the screen now?
Yeah. Yes.
Okay, great. Thank you. Thank you, Haley. And thanks everybody for tuning in, whether it's live or by viewing the recording. Thanks to CapeSpace, Robin and Haley, for asking me to do this presentation, which we're calling Investing in Turbulent Times. It's certainly been a remarkable year, 2020, on many fronts, including the investing front. And I know there was reason early in the year for kind of concern, if not outright panic, and we've kind of recovered a bit, but people are scratching their heads as to what's going on. So I actually think now is a good time to think about some of the lessons that we've learned, and then, help people prepare, in the event that we have some further turbulence as a result of the corona or other things. So this slide here, again, just kind of is from a investing perspective. The U.S. stock market is really a summary of 2020. As you can see, we started off the year pretty well, and by, I think it was mid to late February, the S&P 500, which is a measure of the U.S. stock market, actually hit an all-time high in mid-February, before the coronavirus really started taking over our lives, so to speak. And then from mid-February to mid-March was really a steep drop. I think at the low, the S&P 500 was down about 30% in mid-March. And then, we've been having a recovery. Initially, the recovery appeared to be a result of the stimulus package that went through Congress. And, obviously some bumps along the way, but, we're back almost at the highs that we hit in mid-February. And I think a lot of people are asking themselves, given everything that's going on with the economy and the businesses that are being hurt by the coronavirus, why the heck is the stock market near an all-time high? And part of the answer is that, the economy and the market are not the same thing. That's never been more clear than now. The stock market is always trying to anticipate, what's happening down the road, and not necessarily reflecting conditions as they exist right now. This chart actually takes us through the end of the day on Tuesday. Yesterday we were down a little bit, and the last I looked today we were back up a bit. So basically we've recovered the losses that we saw in mid to late March. And the question is, could they reappear again? And that's why I think it's a good time to do this review. Okay. So yeah, because, so this is an illustration from a former financial advisor named Carl Richards, who actually writes a online column for the New York Times. The name of the column is called The Sketch Guy. And he uses basic sketches like this to illustrate financial concepts and investing concepts to people. And this illustration, which I actually have hanging in my office here, is basically what we're trying to avoid, which is kind of our worst behavioral tendencies, where, the market, and you could be talking stocks, you could be talking real estate, anything where, things are going up in value, and we kind of, we're afraid of missing out so we buy at a high point. And then, we have something like occurred in February and March, panic sets in, and then we sell at a low point and then repeat the cycle until we're broke. And part of my presentation today is to help people avoid making those behavioral mistakes that can really do damage to their portfolio. We want people to buy low and sell high rather than the other way around. So as I said, this is a good time to be doing the presentation, and partly because we have recovered in terms of from an investment perspective to where we were earlier in the year. And that, I believe, makes this a good time to reevaluate what is the risk level in your investment portfolio, and I'm talking could be IRAs, your 401k, or other investment accounts. But, you should always be aware of how much risk, you hold in your investment portfolio. And that really comes down to how much of your money is held in stocks versus bonds and cash. The risk level is really driven by the percentage of stocks in your portfolio. And a kind of what's considered a moderate middle of the road portfolio would have about 60% stocks. If your percentage is higher, that you're getting to be more aggressive. If it's less than 60%, you're getting to be more conservative. And that's something you should always be aware of and review periodically, and then decide at different times of life, particularly as you get older, you get closer to retirement, do I want to take a more conservative approach? The reason I say now is a good time because we have recovered from where we were in, say, mid-March. And, there are times in life where you should be more aggressive or more conservative, but doing those in the middle of a drastic downturn like we had in early March, it may not be the best time because you're kind of reacting to the negative things going on at the time. But now we've recovered, so it's a good time to do that evaluation. Really what you should be doing at all times when you're investing is to set a stock allocation target that you can live with good times and bad. And so, if you're reviewing your old portfolio, the first thing I'd say is figure out how much of your money is invested in stocks or stock mutual funds, and then what is the percentage in bonds and in cash, and then decide, am I comfortable with that level, for the long term? Again, in March, we went through a difficult time, and but it wasn't without precedent. This is just kind of a long-term view going back to 1900 of the stock trend of the stock market, and you see the trend is over the last 120 years is clearly been upward, but there is always difficult times, whether we're talking depression or times of war, inflation, and the global financial crisis, and now the pandemic. And so the reason we invest in stocks is, yes, they're riskier, but the trend is upward, and that's that's how you make money. In order to capture the returns and capture the benefits, you have to be willing to withstand some of the risks. So my suggestion to people at all times, good times and bad, is that when you're putting together a investment portfolio, for the long term, that you build that portfolio with the assumption that steep declines are going to occur. It's inevitable. There are very few things that I can guarantee to clients. The one thing I can guarantee is the stock market is going to go down at some point. I just can't tell you when, I can't tell you how much, and I can't tell you how quickly the recovery will happen, but it will happen, so that you have to be prepared for it. And so when we put together a recommended portfolio for clients, we're assuming there's going to be some down periods, and we have to be prepared for it. And so what we do is we try to protect against those downturns. We try to develop a cushion for clients in cash and bonds. Bonds being much more conservative than stocks, but earning a little bit more than cash. And so everybody needs a cushion. It's just a question of how large your cushion is. Somebody who's younger can get away with less of a cushion than somebody who's getting closer to retirement. When you're putting together that cushion is, any money that you're going to need to utilize, say, in 5 years or less, should not be invested in stocks. Because the chance of a downturn that could hurt you, whether you're looking to buy a house or send somebody to college, it's just too much risk. As you get 5 years or beyond, then you can start looking at should some percentage of this money be in stocks. The 5 to 10 year time frame, it's you have to do a careful evaluation. 10 years or more, I would advocate you should be investing in stocks. But again, it's all about maintaining a cushion so that when the markets go haywire, you can withstand what's happening, so that you can get through a period like we had in February and March. And so, when we do have a spell like that, what I recommend to clients is that they first, rather than try to panic and decide that, they can't take the losses, that they're going to sell everything, sell all their stocks. The first step I recommend is that they review that cushion that we talked about. Again, that's the amount of money they hold in cash and bonds. And, look at that in dollar terms. How much money do you have in cash? How much money do you have in bonds? And then ask yourself, in the worst case scenario with the stock market, how long would that cushion last you? Would it last you 1 year? Would it last you 10 years? If it's only going to last you a year, then, you may need a more conservative portfolio. But if it's going to last 10 years, then ask yourself, is it, do you believe that the stock market will recover within that time frame? And the answer is probably yes. So really, you need to maintain the cushion so that when we go through those inevitable downturns, you can, live through it and not run out of money. If the cushion is large enough, then you can just give the stocks in your portfolio time to recover, rather than sabotaging your future by selling them at a low price. A lot of people, when we enter difficult times, the temptation is to try and time the market. Certainly as the coronavirus started picking up steam in this country, a lot of people, felt that it was inevitable that the stock market was going to go down, and they wanted to sell and say, well, I'll get back in when it's safe. And there's a couple of problems. Is one of it, is it's not a question of making one right decision as to when to get out, but there's a second decision that you have to get right, which is when to get back in. And this slide kind of shows that trying to time the market is extremely difficult, because we don't know on a day-to-day basis how the market is going to behave, both going down, and also no one can tell you when the recovery is going to take place. And so, this slide shows that what is the impact of missing just a few of the really good days in the market if you pull the money out of stocks. And so this shows, if you had $1,000 invested in stocks, what your return would be if you missed, just the single best day over the last 30 years, the 5 best single days, or even just, 25 days. So you can see by staying invested in the market, you're almost at a 10% annual rate of return. You miss 25 best single days, your return is essentially cut in half to 5% on an annual basis. And that's just 25 days out of a 30-year time frame, and it just shows you that the cost of trying to time the market. And so that's why when you hear people on TV, when we enter a market spell like we had, the advice is, always don't panic, stay focused on the long term. And I know people kind of roll their eyes and say, I've heard this a million times, but this is really why people give that advice, is because if you're not staying invested, then you're going to miss out on the good times in the recovery. The saying that I like to share with clients a lot is, to spend time in the markets, not timing them. And what this slide shows is that that the longer that you remain invested, the better the chances are that you're going to have a positive return, positive experience. So over any, going back to 1926, any single 1 year period, there's a 26% chance that you're going to have a negative return in the U.S. stock market. But as the time frame gets longer, you can see that the probability of you suffering a negative return goes down substantially. So at a 5-year, again, this is looking back to 1926, over a 5-year period, there was an 11% chance of seeing a decline if you were invested in the US stock market. Not fun, but it's only 11%. And then as you stretch it out to 10 or 15 years, your chances are having that negative return decline quite a bit. And this is, again, why we say don't panic, think about the long term. There's strong evidence of that approach. So that's why also, why I say if you have money that you need to use in less than 5 years, you don't want to be in stocks. But as your time frame increases, that it's the wise way to go. A little bit about stocks versus bonds. So, the stocks, as I said, are the riskier portion of the portfolio, but they also are have the higher potential for return. This, on the left side, it shows that from 1976 through March of this year, that in any given 1 month period, with stocks, there was a 64% chance of positive returns, meaning in 36% of the time in those months, there were negative returns. With bonds, still could have negative returns, but it's much less. The flip side is that stocks will earn you more money than bonds. Right now, I should point out, it shows over this time frame that bonds, as measured by what's called the Barclays U.S. Aggregate Index for bonds, an average annual return of 7.4% over that time frame. I should point out that expectations going forward, the bond returns are going to be much lower than that because of where interest rates are. We've at a historic low for interest rates, so I would not expect to see 7.4% for bonds. And actually, many people also believe that stock returns going forward in the future are going to be less. So these are historic numbers, but I'm just trying to point out the trade-off between stocks and bonds and the higher volatility with stocks. So I should also point out, I've talked a lot about stocks, but I am also a strong believer that bonds, should be in somebody's portfolio. I never advocate to somebody a portfolio of 100% bond cash, nor do I recommend 100% stocks. It's usually some combination of the two. And part of what we do is help people figure out what is the appropriate mix. But the bonds are there primarily to kind of provide a stabilizing force when we do into those inevitable downturns. And just, some overall thoughts, again, in turbulent times, and frankly, also during the good times, we try to maintain a investment approach that's consistent in good times and bad, but you want to be, focusing on the long term, focus on reaching the goals, and then trying to maintain a disciplined approach, which is, the idea between, investing, staying in the market rather than try to time it. Invest broadly and globally, meaning, we've talked mostly about US stocks, but you also want to consider investing in international stocks. Asset allocation is key. Evidence shows that the greatest determinant of your investment returns is what is your asset allocation, what percentages in stocks, what percentages in bonds. The higher percentage in stocks, the more you're likely to make over the long term, but there's going to be more volatility. Try to reduce your investment in tax costs where possible, and then rebalance as necessary. So rebalancing is a process. Is once you've set your target allocation, let's say you go with that kind of balanced or moderate portfolio of 60% stocks, if stocks do well, then that percentage goes up to 65%. You want to sell a little bit to bring it back down to 60%. And then if stocks actually don't do well and your stock allocation goes to say 55%, you want to buy some more to bring it back to 60%. And that's kind of a disciplined way to make sure that you're buying low and selling high. And that is, I think, it. Is there any questions from anyone?
David, I see we got one question from Robin here. um, asking if we're at the point where we should really be talking about tech stocks in their own category and not lumped in with all the other stocks.
Good question. You're talking kind of like the Facebook, Amazon type things. I wouldn't talk to them apart.
I'll go ahead and, I'm sorry, I'll go ahead and unmute myself for a second, explain my question. Yeah.
Sure.
Really, when you're looking at asset allocation and you're talking about risk factors, you know, you mentioned early in your talk about it is very confusing how we can be seeing all this dire predictions about the economy, but yet the stock market's up. Like, how can that be, right? And I've heard several different explanations for it. One being that interest rates are so low that people just don't have any place else to put their money, so they're putting it in the stock market. And another one being that the averages that we look at are so heavily weighted towards these big tech stocks. So I just wonder if there's actually a different risk profile for certain classes of stocks today.
Yeah, I mean, and that's always the case if you're looking at U.S. versus international stocks, or you know, U.S. large caps versus emerging market stocks. So there are various asset classes or subclasses within the broader stock category, and they're always, each one of those always has different levels of risk. Like in emerging market stocks, you know, such as, you know, a mutual fund that invests in Brazil, China, India, historically is more risky than something that invests in the U.S. So I would still, you know, like those big tech stocks that are dominating right now, I would still, you know, include those in the broader category, but to pay attention, you know, how much of your portfolio is in those types of stocks. And, you know, I would advocate you don't want, even though they've done extremely well, you know, over the past few years, you don't want to have everything in those types of stocks because at some point the trend is gonna revert. There's a concept that's called reversion to the mean. So right now, stocks like that, what they call large cap growth, have really dominated, and others, smaller companies haven't. But you need a balance of both.
And can I also ask your opinion about for people who are invested in annuities,
Yep.
Considering the some of the predictions about the economy, what is your personal feeling about how safe those annuities are and the ability of the annuity issuers to, you know, be around for the length of time they would need to pay out on these investments?
Yeah. So annuities are generally, you know, insured at the state level. So there are kind of state guarantee corporations, just as with a, you know, say like a life insurer or a you know, a home insurance provider. There are state insurance guarantee funds that are designed to provide a backup in the event, you know, an insurance company, which is what provides annuities, if they go under. So there are, if you're buying an annuity, one of the things you can ask for is what is the credit rating of that insurance provider. And certainly, you know, some annuity providers, some insurance companies have better credit ratings than others, and that should be a factor. You know, so generally, I'm not aware of any situations where clients didn't, you know, get the money that were owed to them because of an insurance company collapsing. But it is you know, a risk level to a degree.
So you're still putting your clients in annuities?
We don't rely upon annuities that often. It varies by the type of annuity. We to recommend in some situations what they call a single premium immediate annuity, which is just kind of, you know, somebody turns over a certain sum of money in return for a monthly guaranteed income for the rest of their life. And then there are variable annuities, which kind of get more complex, and but there's nothing about the economy or the industry right now that would cause me to avoid recommending annuities at this time. It's probably more about the qualities and characters of this specific annuity itself, rather than a concern about, economic conditions.
Great, thank you.
Any other questions? David, I actually have one question. What would be your advice to someone, maybe like myself, someone maybe who's in their late 20s, early 30s, who maybe hasn't started investing yet? What would be the first step or kind of first thing to be thinking about in terms of investment?
Get started now, because the biggest advantage you have is time, and that's somebody like me in my mid 50s, I'm not getting back that time. The two places to start for a young person to start investing, I think, is one is if you have a 401k plan offered through your job, absolutely sign up. In tandem with that, or if you don't have a 401k, I would set up a Roth IRA. A Roth IRA is very powerful for a young person because the money you're investing, you pay taxes on the front end, but when you withdraw it in retirement, it's tax-free income, and those tax benefits just explode the longer the money's in the Roth IRA. So definitely, get started through a 401k and or a Roth IRA, and then put it on autopilot so you don't have to think about it. The people that we see that do the best financially, it's not because they're stock picking geniuses. It's because they invest each and every month on a consistent basis. It might be a small amount, but autopilot is the single most powerful force in investing, is my belief. And if you're in your 20s, early 30s, it's tough to go wrong. You don't want to lose that time. The other thing I would point out is, this goes beyond your question, but sometimes we get young parents who come in and they're all focused on saving for education for their young children for college, which is obviously a huge expense. But I tell them to focus first on retirement, because that's the more critical need. And if you don't want to lose those early years of investing, because if you do a good job, say starting to save for retirement early, and you start to build up a good nest egg, by the time your kids go to college, you have more flexibility. You might actually be in a position where you can kind of scale back a little bit on the retirement contributions while the children are in college. But if you haven't started early enough on retirement, you lose that flexibility. So start early, put it on autopilot, and don't even worry about temporary blips like we've had.
Great advice. Appreciate it.
And as Haley's employer, I would just throw in that what he means by autopilot is you can actually set up your direct deposit so that a portion of your funds just go directly to your investment account.
Okay.
You don't have to consciously move the money.
Yeah, I can help you with that if you'd like. I'd be more than happy to.
Awesome. I appreciate that. I might take you up on that.
Anytime if I can, anytime I can get, a young person, just putting it a little bit at a time, no matter, how big or small, it's a victory. So I'd be happy to help.
Awesome. Let's see, anyone else have any questions? No, I think we're good. David, any last thoughts?
No, I mean, just, like I said, it's, if you were skittish as to what was happening in March, I think now is an excellent time to review where you stand. If you feel like you need to make some adjustments, it's a good time. Use myself as an example. Before the coronavirus had hit, I had been considering reducing the stock allocation my wife and I use for our retirement savings. when things kind of imploded, I didn't want to make a move. But now that I've recovered, I'm starting to think about it again. And so the market is at a relatively good point right now. So, now is a good time to think about those adjustments.
Wonderful. Well, David, thank you so much. Really appreciate your time here, and this is very valuable information.
Thanks.
Yeah.
Thanks, David.
Bye.
Bye.
Bye.